Hey folks, welcome to another episode of the Quiet Life Podcast. My name is Joe Valley, your host, and I have a special announcement today, so don't fast forward. I want to go ahead and try to do what our friends at Ecom Crew do. Our buddy Mike Jackness over there does something called Under the Hood. It's an episode where he will have somebody join the podcast to talk about their business and growing it from the marketing side. What I'd like to do is an Under the Hood for somebody that wants to exit their business. It's almost like it's going to be a live discovery call or valuation call. We'll do it without giving away the name of the brand itself and try to be as confidential as we can with all those details. It'll be discussed in advance, of course, with the person that we decide to do it with. But if there's anybody that's interested in that, I've done no preparation whatsoever in terms of a form to fill out or anything like that. So just hit me up with an email that says Under the Hood in the subject line and shoot me an email at joe@quietlight.com, and I'll reach back out with a form you can fill out and see if we can get you on the show for an Under the Hood segment. Okay, appreciate you tolerating my little spiel there. Now let's go on to the good part of today's podcast. We've got Asher Ismail on the show today talking about getting funding for e-commerce businesses, something that we all struggle with from time to time. It's been an issue, especially if you're growing rapidly. One of the hardest things to do is get money to buy more inventory. So we're going to talk about that today and much more, a little bit about Asher's story as well. Asher, welcome to the Quiet Life Podcast.
Hey, thanks so much for having me. Really looking forward to the discussion.
Good to have you here, man. Let's talk about your journey. You're an entrepreneur, just like me, just like everybody that's listening or that wants to be an entrepreneur. What is your journey from an idea of maybe starting this company to making it come to fruition? How did it all begin?
Well, I guess Uncapped was really born out of my own frustrations of, raising capital. It's the challenges I faced when I was first launching that initial business. I started back in 2003 and I was young and I was just trying to raise 100K, and I probably had 100 meetings and 100 no's. And, I didn't want to take financing from the banks because they all wanted personal guarantees, and venture capital wasn't ideal either because I didn't have a track record or connections or warm introduction. And so I just repeatedly missed out on growth opportunities. And then when I was raising money for my second business, I thought I had it all figured out and I raised millions in venture capital money, but I also got terribly diluted. And I just started to realize that the options for me were really limited. And it was just depressing to think, I could work so hard and own so little of my company. And I guess I just noticed it wasn't just me. Growing businesses were often left to choose between raising costly venture capital or burdening themselves with traditional debt. And so, I thought there must be a better way. And I started to work on Uncapped and basically to bring this more fair alternative to funding first to Europe and now North America. And, since we've now given, over $150 million of funding to businesses and gone on to create lots of great opportunities, but also helped a lot of e-commerce owners really keep more of their business and, save millions in dilution.
Let's talk about the difference between venture cap money and dilution versus funding for businesses. Can you just define the two for myself and the audience?
Yeah, well, I would say first that I think probably investors have been pretty uncreative in terms of how they've, thought about funding businesses historically. And the two traditional models are either, you saddle your business with debt, which means, going and taking out a loan. And, often that can be very restrictive for the founder. It takes a lot of time to raise and also can come with personal guarantees or covenants attached to them. And I'd say, debt, it's really designed for unlocking liquidity from fixed assets. But the truth is that, fast growing e-commerce businesses, that's not something they usually have. And then on the other hand, of course, equity is a great thing for funding uncertainty. But if you think about, raising large amounts of equity, say, for example, from venture capital, 0.05% of businesses raise money from VC. We talk about it a ton because obviously we see all the big headlines of folks raising large amounts, and you can't blame founders for wanting to chase that because that's what you might see in TechCrunch or other things. But the truth is that for so many businesses, it's not necessarily the right choice because it's incredibly expensive. It also takes a long time to raise.
Expensive
and
in
can
what
mean you
regards?
give up control.
You lose control of your business and you don't have as much of your own equity. Is that the way that it's expensive?
Yeah. So, typically with each funding round that a business does, you're going to give away 20 to 30% of your business. And once you give it away, you can't get it back, at least not very easily. So it can be, a very expensive way if you really believe in the value of your company being a lot greater in the future. And I think most of us entrepreneurs like to believe we're building and working on something every day that's really valuable and will become more valuable in the future. So yeah, it's costly.
So, Mark, my business partner, and I were just chatting about some news that came to us that a company called Micro Acquire, which is a platform for buying and selling small online businesses, just raised some venture cap money at an $80 million valuation. So they raised $6 million at an $80 million valuation. The first comment that Mark made was, that's what happens when you bootstrap a company and it's not profitable. You raise money. Would you agree that that's an accurate statement?
Well, I would say, if you think about bootstrapping in general, the principle of it, right, is that actually you're self-funding, right?
Exactly.
But the challenge of bootstrapping is that it limits your growth. So because you can only reinvest the profits into gaining that additional growth. And so, yeah, if you have a bootstrap business that reaches a point where actually you're trying to say, hey, we want to actually grow at a much faster clip, maybe to do something that outpaces, what our current profits generate, that's when you might move to saying, hey, equity, it's now the right time. You have to really believe in that next, the next second act, if you will, of the business.
Mm-hmm. Mm-hmm. And you really have to, I think, understand yourself as an entrepreneur, first and foremost. Do you want to have essentially business partners? You become much more of a grown-up very quickly, I would think, if you raise venture capital money than if you're bootstrapping and growing slower. And with revenue-based financing, which is what you do and others do it as well, the owner of the business chooses how quickly they want to grow based upon how much money they can get from financing, and they still own 100% of the business. It's got a fancy name, revenue-based financing, but it's essentially a loan, and they get paid back how? From a percentage of the revenues? How does it work?
Well, I think we like to think of ourselves quite different from a loan, because I think a traditional loan, when you talk about it, has an interest rate, mm-hmm. and it also has a term. And one
term
of the things
being a fixed payment
fixed
over
term,
a certain amount of years.
Exactly. A date which you need to repay these funds by, and probably fixed repayment structure. Right. And that can also be one of the most challenging things, because if you're running a business where there's some seasonality, pretty common in e-commerce.
Yeah.
If you're running a business where there's some variability in how you're doing, or in our current climate where you're having some of the challenges around what we're seeing with suppliers, yeah. and the timing that revenue is going to come in, that makes a lot of entrepreneurs worried about going out and taking additional capital. I know for me, that was always my biggest fear. I was like, hey, if I go in and take this other fund, will I actually be able to pay it back? Am I going to afford those repayments? Will actually what's supposed to be the solution to my problems actually become my biggest worry? So, what we're really passionate about at Uncapped is that, founders shouldn't have to give away equity or, take on a personal guarantee to fund their growth. So we provide fast, flexible funding to e-commerce businesses for marketing, for inventory, for hiring, for acquisitions too. And we do it without those personal guarantees or dilution. And in terms of how the model works, it's pretty simple. We provide this capital that starts from 10K up to 5 million, and we charge a flat 6% fee on the capital that we provide. So businesses only repay the capital as they make revenue, and there's no set repayment date. There's no compounding interest. It also means that businesses don't have to pitch. They don't have to create a business plan or go and have a bunch of coffees with investors. And I think that's super important, because it means that they can get back to actually growing their company, focusing on their customers and their products and their team. And typically we're funding businesses in 24 hours.
Tell me about the repayment schedule. You said it's revenue based. How does it work?
Yeah. So, unlike a loan, because the repayments are tied to your revenue, if the business slows down, the founder isn't cut out. The repayments also slow down. So, we're taking that fixed portion of your daily sales. Say, for example, you wanted 100K to spend on marketing. We'd take back a fixed portion of your daily revenue. That might be like 5 or 10% until we get 106K back. So you're just paying that 6% flat fee.
That seems incredibly reasonable, that 6%. How long have you been doing this for?
So we've been going since 2019, so just over 2 years. We've grown incredibly fast because I think entrepreneurs have realized that, hey, there should be a better way to fund their businesses. So we started in the UK. We're now in 22 countries, including the US, Germany, Poland, Spain. And yeah, I've been just growing exponentially, deploying hundreds of millions of dollars. We actually now fund more businesses in a day than a typical VC will fund in a year.
Incredible. Let's talk about a word you uttered in there, which was acquisitions, that you actually fund acquisitions occasionally as well. Half our buyers are half our listeners are probably buyers or will be buyers at some point of these online businesses. Talk to me about the funding for acquisitions, please.
Yeah, I mean, this is such an interesting space and obviously really expanding. Like you mentioned, microacquire earlier as well as being like, a way that bootstrapping businesses are, starting to be able to get, more acquisitions happening. But I'm sure, in your space, I know how much you guys have been growing and, I can only imagine that space is getting hotter and hotter. One of the challenges, of course, of funding acquisitions is the funding for them can also be really slow. And, part of being an attractive buyer is also being able to access the capital that you need to be able to make that deal quickly and, having the confidence that you can go out and execute against it. It's also about, the opportunity, because I always think like, strike while the iron's hot is a phrase I probably say too much. And I think it matches that mantra of like, the funding is the key part that often is the slowest part of the journey. So yeah, we've been increasingly working with businesses that are looking to acquire other e-commerce businesses and helping them get deals done.
Can it be someone that is in the corporate world wanting to leave that world to buy an online business? They've identified one and you give them funding based upon the business that they're going to buy, or is that not the case?
Well, historically, our approach has really been looking at an existing business and using, the same approaches and analysis that we do.
Okay.
And then thinking about that ability's business to acquire an additional one.
Okay.
Maybe I should explain a little bit about how our model works and like how we're able to make decisions so quickly.
Please do.
And it comes down to basically our underwriting process, if you will, which is a bit different from what a bank or a VC would do. How we work is that we connect to the data sources that the business already uses to run. So that might be your Facebook account or your Stripe account, your Shopify. And we use that live data to be able to make a really quick, but also like unbiased decision because we're using the live information about how you're performing rather than, the background or the profile of the entrepreneur. And it also means that it simplifies that process overall because it's not like a complex due diligence that you'd normally have to do when you go out and raise funds. Because we've used this live real data, we're already confident in our decision and we can actually get you the money really, really quickly. So it's a technology-driven approach, a data-driven approach, but one that is also therefore incredibly fast.
Are you guys losing any money in this process? I mean, you got to make some bad bets now and then, right?
Well, what's funny about our model, what we like to say is that, we never make an offer to founders that we don't think they can afford. And I guess our approach is a bit different because, in a VC world, they need, 1 out of 10 of their bets to pay off, right?
Mm-hmm.
We need 99 to 100% of the bets that we make to pay out. And so that means we're really focused on using this data in this intelligent way to really make good decisions, but also about supporting the businesses that we go on to fund. So, we like to, use the same data insights to actually be the smartest money that a founder can get. A lot of investors talk about being smart money, but we try to be the smartest money because actually we have the data insights to help businesses unlock additional growth. So, the underwriting we use, we can turn around and, share that with an entrepreneur and give them input and ideas about how they can, take their business to that next level and hopefully pay us back as well. It's a real win-win relationship.
This might be a silly question or a dumb question, but it seems like your margins are very tight as a business model, right? You're getting lending to then share with these entrepreneurs. and your markup must not be very high because you're charging 6%. You're getting your money at 2 or 3%. How's it work? If you don't mind divulging some of your own business model.
Well, it works out for us, I guess, in the sense of, being really confident about who is repaying us and, making sure that those two pieces work together. There's also a broader approach. So we're now not only helping entrepreneurs think about funding, we're also helping them with the broader set of financial needs. So, recently we, launched more into banking generally, about helping e-commerce entrepreneurs access other tools and services that support all those other financial needs they might have, from the basics of what you would expect from, a modern digital bank, to also, unique services that are really designed for e-commerce, that, for example, help them access their cash faster or pay their bills in automated ways that save them time and money. And, where it's part of a broader strategy around how we're going to, tackle the entrepreneur market.
Wow. Interesting. When an entrepreneur is out there growing, their business is thriving, but they're short on cash, is that the time to make a decision to reach out to you, or is there some magical best time to talk to you?
Well, my advice generally always about fundraising is, if you want to be successful in fundraising, you don't want to do it and from a moment of desperation
When you need it.
right?
Yeah.
And, I always say as well to entrepreneurs, the first question to ask when you're raising money is, do you really need to raise money? Which is kind of a funny thing to say as someone who would be lending money to businesses. But I think it's so important because, so often I say, I see entrepreneurs who just think, hey, I have to raise this money. It's the only way that my business is going to work. But of course, if you understand, what you would do if you didn't raise that money, it actually means that you're now be able to understand how to make your business work. And knowing that removes the desperation and actually just makes you much more investable.
Is it only e-commerce that you fund? Because, when we think e-commerce, it's generally a physical product-based business. Of course, it's all e-commerce because it's electronic commerce. But are you funding SaaS content sites, different types of business models that are online businesses, or is it just physical product e-commerce businesses?
Yeah, there's a joke that's going around, of course, that soon, commerce will, or e-commerce will just be commerce, as every business kind of goes online. But yeah, we do support other business models as well. So, we have funded companies in the SaaS space. We fund other companies that are other types of subscriptions or marketplaces. E-commerce, of course, has been huge because of the incredible growth that we've seen in that space, right? It's like an unprecedented time of growth and opportunities. But yeah, we have funded by businesses and a lot of other areas as well. Actually, one of our biggest, customers in the UK is a company called Marshmallow, who, offers insurance to, expats and immigrants. And, they've recently gone on to be, the second Black-owned unicorn. So, we're really proud to be, part of the story of some of those businesses. We ended up saving them £7.5 million in dilution. So it just shows you the value of being able to switch up how you think about your cap table a little bit and optimize it. It was actually funny. We were talking to, they told us a story where they were like discussing with their investors who had come into the round, and they were like analyzing their business. And they were like, hey, how do you guys build such a big business? And you guys own so much of it. What are we missing here? And they realized, you guys work with Uncapped, and they got it. So, it's like great stories like that of, how we can help other types of businesses as well, just, save some dilution and keep more control.
Do you have any other, smaller success stories that are in the physical product e-commerce business?
Tons.
Let's hear a couple.
One I love to talk about is a fashion brand called Headwind. They were one of our first customers. And, like so many e-commerce entrepreneurs that are working in fashion, they had to juggle cash between inventory and marketing. Mm-hmm. So they'd have to wait basically for the current season to sell so they could invest the returns in the next. And that really limited their growth. And Alex and Anna are the other founders of Headwind. They're incredibly savvy. They both came actually from finance backgrounds. So they assessed all the options. They went and looked at VC and venture debt, but they just wanted a more affordable option to get them to that next level. And so they signed up with us for an advance of, $50K and they used it to increase their inventory. And with that new funding, in a quarter, they saw their revenues grow 11,000% compared to the previous year.
It's a big number.
And it's pretty incredible, right? Because if you take, some great founders with a great business model who were just constrained by something as simple as being able to access the inventory that they needed, they were able to unlock incredible growth. Other businesses that we would see, I guess, right now, so many founders, I think, have been really struggling with the global supply chain challenges, of course. So I think a really awesome story that just happened recently was an entrepreneur had saw that challenge in the previous period, and the fact that their inventory time periods were just taking way longer. And there's so many entrepreneurs who have just been kind of stuck out from that situation, where then they end up having a stock out or a problem. And this particular company, they took a different approach, and they said, hey, let's actually make that into an opportunity. And they went out and talked to their suppliers, and they said, hey, if we actually bought, double the normal inventory that we'd buy, could we get a 10% discount? So they negotiated that. And then of course they turned around and then got the capital from us for a 6% fee. And they took something that otherwise was, I think, causing so many entrepreneurs to have a headache and actually improve their margins. So I think there's great ways that people can, if they're being savvy about their business and they understand the dynamics of what's happening, they can actually take some of these situations and actually make them, a real great play that works out for them.
It's so desperately needed by so many people. And that example of, negotiating a reduction in cost of goods sold adds so much value to the company, to the bottom line, to their pocket, but almost so much value when they eventually exit the business as well. And they did it with your money, which is great. Instead of their own, a lot of folks in this business, just they bootstrapped it. They used credit cards. They used a HELOC. They used money from friends, family, anywhere they could get it, beg, borrowing, and stealing. But the growth of businesses like yours, I think, are really tremendous in helping entrepreneurs get out of that cash strap bind. And working with the traditional banks, just not a good thing, right? We personally quite like setting up a line of credit with Bank of America, and it's a royal pain in the butt. So much to the point where Mark and I still have the form in our inboxes and we haven't filled them out because it's just, it's not fully necessary, but we just feel like we should have one, but they make it so much more complicated than they need to. So good on you. I think it's a great opportunity for entrepreneurs to get some capital for more inventory, renegotiate your cost of goods sold in the process, and stop being so cash poor in their businesses. So it's great. Tell me the difference, though. There's a few different companies out there like yours that are doing this. You're very accessible. Your site's really clean and easy. I looked at it, page one, boom. I fully understood what you did. What is it, though, that sets you apart from others that do the same similar type of funding?
Yeah, well, I think, the biggest thing is that second part in banking that you were mentioning. So you were talking about, hey, the challenges of opening up that bank account that you're having, where we're really trying to expand and support entrepreneurs is not being just part of their funding story, but being part of their overall growth. And, with us, we had a customer who opened up their Uncapped bank account in 1 minute and 40 seconds. So that just happened yesterday. So, I think that it is such an opportunity to be able to help entrepreneurs on this broader range of services and think about, all the ways that we can help them grow. And so I think that's one key thing. When it comes to our funding specifically, I think it's about the support that we're giving entrepreneurs after they get the money. So many times people are focused on, hey, how do I first just get the advance at the lowest price possible? But I think the support and service and, knowing that we're there to help you, have one of our reps turn around and be able to talk to you within an hour to be able to, talk about a future advance or additional funds for an opportunity you had, and also consult with our advisors to get ideas and insights about how you can leverage our data to help you get more growth out of your business. So we just want to keep adding, more value add to what we do and delivering great service and getting, awesome recommendations, because that's really what's, helped us grow to where we are today.
Well, I think you're going to grow a lot more based upon what you're telling me. You're in the right place at the right time, helping lots of people who need it. So good for you and good for the folks that are going to be able to work with you. Asher, how do folks find you online? How do they reach out to you? How do they learn more about what you do?
Well, first of all, visit our website at weareuncapped.com. I also, if you want to reach out to me, I'm on LinkedIn, and actually every week I'm sharing ideas and content about helping entrepreneurs grow their business or deal with the different scaling journeys along the way. So, great follow for insights there if that's of interest. But I also wanted to say that we had a little bit of a special offer for your listeners. Last month we ran a really successful campaign where we have e-commerce businesses that are doing at least 10K per month, and they wanted to scale faster to purchase more inventory or accelerate their marketing. And we ran this campaign last month where we were able to fund hundreds of businesses, and we gave them up to 50K of funding for absolutely free, so no fee. Normally we charge a 6% fee, but last month we did it for exactly zero. And on our website, you won't find mention of it anymore. It's gone. But Joe, for listeners of your podcast, we're ready to make it happen again. So all you have to do is reach out to me at asher@weareuncapped.com with the subject line secret 50K and a bit about you to see if you qualify. And yeah, we'd be really excited to hear about your store and get you some more funding to grow it even faster.
Brilliant. I love it. We Are Uncapped, or Asher at We Are Uncapped. Fantastic. Asher, thanks so much for your time today. I really appreciate it. We're going to need to check in another 6 to 12 months to see how much you've grown, because I think it's going to be pretty tremendous. So thanks for your time today. Appreciate it.
Thanks so much for having me.